welcome to the Monday Futures Market Outlook for December 19th, 2011. This is Patrick Serezna. For those of you that have not had the opportunity to try out eminisource.com's trading room, 5-day complimentary memberships are available on the website. As always, we start off with a weekly chart of the S&P 500 going back 3 decades. We plot an 80-week moving average on there. It does a very good job to depict the bull and bear market cycles the market has gone through. Over the last year, we've seen numerous breaks higher and lower of this 80-week moving average, just confirming the amount of market chop that we've seen and the non-commitment of the markets to making a substantial new trend. We're now going to be watching into 2012 indications as to which way this market really wants to trend for the year, and it literally will be happening off of this 1200 level, and the pivot from there, whether bull or bear market, will probably mark a substantial move at some juncture here over the next month or two. Just to make some key intermarket observations, the euro continues to consolidate right now at the 130 level. If the euro finds a short-term swing bottom, it will cool off the US dollar and allow commodities and the stock market to stabilize into the year end. Right now, over the last even few weeks, we've seen a strong US dollar and strong US Treasury bond prices that have been driving fear into investors holding risk assets, and we really need to see the market cool off from that a little bit. In isolation, the charts on the S&P continue to favor the upside, but it's clear that these global cross currents continue to play villain. When we take a look at the daily chart of the S&P 500, well, the one thing we're focusing on this week is this flagging formation developing here. We're right now holding right in the Fibonacci retracement zones, and this 1200 level will play a crucial round number role here. We've now tested that 1200 zone numerous times. And if the market here can actually reverse off of that, there's room for a year-end rally back up to the highs of October and December, up near the 1275 to even 1290 levels on the upside. If the market turns bullish into January, there's room in the new year for even a move up to 1340. But again, at this stage, let's just see whether this 1200 support holds and create some positive price action off of that support. Next year, we're going to take a look at the US dollar index futures, and the US dollar has broken to a higher high, and this has really solidified that whole US dollar trend that's been in place, and really at this juncture, while the US dollar may strengthen here, if we do see that euro stability, this could be a false breakout on the upside and have a quick reversal back in and below the 80-50 area on the downside to kind of cap that upside. Really, at this stage, in the bigger picture, we don't object to the idea that the US dollar could have a substantial uptrend. We just don't believe it's at this stage it's a little stretch to the upside, and it's likely to first pull back before resuming a big uptrend. Next year, when we take a look at copper futures, we see copper stabilizing that 320, 330 area on the downside, but really the possibility of a bullish breakout on the upside has substantially diminished. The fact that copper has deteriorated all the way down to these lower prices is demonstrating a distribution cycle in copper, and if we go through any extended period of strong US dollar strength into the next year, then copper prices will continue to be under pressure. When we take a look at crude oil prices, crude kind of created a little double top along the 101, 103 level, and rather than having a nice bullish breakout, it's now consolidating. We were talking about at some stage even just a retracement back to this 90, 92 level. We came literally within a hair of that downside target over the last few days. Overall, though, we remain optimistic that crude oil could find support here and bounce back higher, but just like copper, the worst possible thing that could happen here is that it rallies and fails on the rally and subsequently finds itself back down at this 90-92 level very quickly. The more price action that we have down here, and the longer it takes for this a bullish reversal on the upside to grab hold, the less optimistic we would become. And so while right now we're trying to be optimistic on crude oil, it will be very important that it has some sort of follow through over the next few weeks. Next year, when we take a look at gold futures, gold really deteriorated below that trend line and found itself very quickly down at our focal point at the 1570 to 1600 level on the downside. It's also where most of the key low levels came in September. Really, at this stage, it is likely that gold will bounce, but if we have gold here rally, let's say back to 1620, 1630, 1650 on the upside, and then subsequently fails, we will probably see gold even still have one more good consolidation down to 1460 to 1480. Overall, there's no reason to believe that gold will not hold its supports. More than likely, it will be a very range-bound price action going into next year. Finally, I want to take a look at the 30-year Treasury bonds, which continue to consolidate up towards their highs. There's some substantial overhead resistance in this 146, 147 level, but there's a number of measured moves that go even as high as 150 or 152. Overall, we continue to want to look for a high and subsequent reversals of the 30-year Treasury bonds, but there is still no technical evidence beyond overhead resistance that a Treasury bond reversal is underway. That was your Monday Futures Market Outlook. Thank you for joining me.